So we're just going to give everyone about a minute or two just for people to start joining. Looks like we have a few participants in already. So I'm going to, let's see here. I'll give them till 5:02, 5:03 to log in. And I know we have quite a few slides, so I will start exactly at 5:03. Just sometimes it takes individuals a minute or two to log in. Okay, so it looks like I'm going to go ahead and get started, and it'll just be the introduction, so that'll give some people still who are trying to log in by the time you start, Lisa. So good evening and welcome everyone. Thank you for joining us this evening for the second webinar of a 5-part webinar series on first-time home buyers, your pathway to home ownership. I'm Suhey Mojica. I am the Senior Coordinator of Business and Assets of the San Pablo EDC, and presenting with me tonight is Lisa Marie Weathers. Today she will be presenting and discussing understanding credit. But just before I introduce her and she gets started with the presentation, I just want to go over some housekeeping items. Please keep in mind that this webinar is being recorded for others to watch later, or if you would like to revisit any information that you would like to review again. It will be available on our website at www.sanpabloedc.org. All participants and all attendees are muted. If you have a question, we welcome all questions. Please use the chat or Q&A feature on the bottom of your screen. And then I will let Lisa know that there's a question. Lisa, would you like to answer questions as we go, or would you like to wait until the end of the presentation? Just so that I make sure.
I don't mind either way. I can do it either way, whatever works.
Okay, sounds good. Okay, so yes, so please go ahead and type them in the Q&A box. Just because it's a webinar, it's not as a meeting where individuals can unmute themselves. So all questions would need to go in the Q&A box or in the chat box. And then, as Lisa said, we will answer them during and also at the end of the webinar. And so just before we get started, just want to give you guys a little bit of information in regards to what San Pablo Economic Development Corporation is. We are a nonprofit, and we provide various community services and programs, either to businesses or to families or individuals. For businesses, we have technical assistance. We also have membership and sponsorship benefits for our business community. We also provide information, resource, and tools on access to capital. And as you can see, as part of our webinar today is on home ownership. We do have several programs that we help families who are looking to become homeowners. We also do have a job development and career counseling. We have a workforce team that can help you with that. We also do help individuals with degrees and certified training and employment support services. So if you would like more information on any of these programs or services that we provide here at San Pablo EDC, I will have my contact information at the end of this presentation. You can either give us a call or email us or visit our website. And today, with no further ado, our presenter is Lisa Marie Weathers. Lisa has been a longtime resident of the Bay Area. She earned both her BA and MA in communications from San Francisco State University before becoming an entrepreneur in San Francisco. But she ultimately settled on the work that fulfills her the most, which is meeting and helping people from every walk of life who understands the value of homeownership, but who may need competent help to realize their dream. So yes, so the webinar was possible with the help of our wonderful, again, partner, Lisa Marie Weathers. So we are really grateful, Lisa, for your partnership and collaboration with San Pablo EDC. And so I know she has a lot to cover today, so I'm going to go ahead and give her, now she will start presenting to you all this valuable information on your credit.
Okay, good evening, or whatever time of day it is that you might be seeing this. First, let me apologize for my voice. I'm not sick. I just have an issue that makes me sound like Minnie Mouse. I have some water here and I might take a sip every once in a while, but it doesn't really help. So today we're gonna go over your credit rating, talk about a little bit about credit reporting agencies and what is on your credit report, what is a credit score, and how to improve your credit record, although that's something that you will need to work individually on with your loan officer, hopefully, if that person is competent to help you if there's any issues on your credit report. We'll talk about what to do if you don't have a lot of credit history. We'll talk about managing debt, a little bit about identity theft, and knowing your rights as a consumer when it comes to credit. Next slide. Okay, so let's start with the 4 C's of credit. Now, you may have heard of the 5 C's, the 7 C's, there are a lot of C's, but basically it just boils down to lenders wanting to know. It's a way for lenders to understand you and wanting to kind of mitigate any losses or risk to make sure that if they lend you hundreds of thousands of dollars, that you actually are going to pay them back. So the 4 C's that we're going to talk about are capital, capacity, credit history, and collateral. And then I'm also going to talk about circumstances because that's important. Next slide. So, capital. So capital is just money, basically. And so down payment is a huge part of getting a loan. When your lender's looking at you to determine whether or not you're going to be able to qualify for a loan, they want to know if you have access to down payment, but please be aware that depending on the program that you're getting, you may not actually need a down payment. You might be able to layer various programs of assistance. You might qualify for a program like a VA loan, Veterans Administration for Veterans, that will not require you to put a down payment. So all of these things that I'm talking about, keep in mind that these are general guidelines. Everybody's loan is going to be a little bit different, just depending on, the structure of your loan and what you're trying to achieve. Another thing that is important when you're buying a home is that there are going to be fees. So, and closing costs, a lot of different things that add up in this whole process of buying a home. So let's say, just to keep it, the numbers round, let's say you want to buy a home that's $100,000. Of course, that's not possible in the Bay Area and not too many other places either these days. But let's say you want to buy a home that's $100,000. A lot of people think that you will need 20% down in order to get into a home. Like I said, if you're getting a VA loan or some other types of loans, that's not true. You won't need any money down. If you're getting an FHA loan, which is the Federal Housing Administration, it's you may only need 3.5%. For your down payment, if you're doing a conventional loan, doing various programs for first-time home buyers, which really try to help you get in with an affordable payment and with as little money out of pocket as necessary. Conventional loan is only 3% down, but there are fees depending on your lender. They may charge you an origination fee. You have to pay for your credit report, and that can run, you know, from, it might be free, it could be $100, just depending on who your lender is. And then closing costs. Not only are you having to put up the money to actually pay the cost of the home that you're trying to buy, your that's 100% of whatever it costs to buy the home. You have to also cover the cost for whatever your lender is going to charge you, and your escrow officer. Because when you get into purchasing a home, you are going to open escrow, and that's basically a independent third party who is going to be in the transaction, who does not represent the buyer or the seller, but they are there to make sure that everything that needs to be paid is going to be paid. And when the transaction is done, you will get deed to the property free and clear without anything owing. So closing costs could be things like title insurance. You will definitely have to pay for title insurance because your lender is going to issue a title. I'm sorry, your escrow officer title company is going to issue a title insurance policy that ensures that once you buy this house, even if there was something in the paperwork that really means that you don't actually own the property, your insurance is going to cover you, if that makes sense. Impounds are basically money that you have to pay upfront, especially when you're a first-time home buyer. Most programs want you to pay in advance the money that's going to be due for property taxes and for homeowners insurance. So let's say your homeowners insurance, your property taxes are, let's say your homeowners insurance is $1,000 a year. When you're closing on a home, you're going to have to pay upfront the cost of your 1 year of insurance. And then once you start making your mortgage payments, you're going to have to pay 1/12 of the insurance and 1/12 of the property taxes. And you pay that along with your mortgage payment, including the principal, interest. Then you're paying property taxes and homeowners insurance in smaller bites, so that when those bills come due, your insurance is due usually once a year, and that money is going to be sitting in the impound account, so that when the bill comes due, your lender is going to pay it for you. So you don't have to worry about you lapsing or not paying your insurance, and then the property is not covered, or same thing for your property taxes. Now we have reserves here, but more and more it's not being required because most people just don't have it. One of the biggest obstacles to owning a home or buying a home is coming up with a down payment. And so if you don't have a lot of money to cover your down payment plus all of the closing costs, you're probably not that likely to have reserves. So most times it's not required, but if it is required, basically what it means is that a lender might want to see 1 or 2 months of whatever your monthly payment on your loan is. They want to see that sitting in the bank at closing to know that you have a little bit of a cushion. And then of course, the thing that most people don't think about is that once you close on your mortgage, on your home, you have to pay moving expenses for, your truck and whatever, movers and all that stuff. So that's the capital. Lenders looking to make sure that you have all of these things, but keep in mind, they're not always required in terms of like reserves, or you may not have to pay a down payment at all. And loan fees could be, they can add up or maybe not. It just depends on what your lender is doing. Next slide. Capacity. Now this is, they want to make sure that you actually have the ability to make your mortgage payment every month once you close on your home. So of course they're going to look at your income. Now that can be income from a job, or that can be income from a pension. It can just be Social Security. It can be whatever your source of income is. But what our lender is looking at is to make sure that whatever your income is likely to continue. for 3 years to make sure that you're going to be able to make that payment. Now, there's no way to know for sure because you could close on a home today and lose your job tomorrow. But a thing that they're also looking at is your history over time to make sure that you don't have any big gaps in your employment and to make sure that you have a consistent history of working and paying bills on time. Another thing to do with capacity is how much you're borrowing. So, if you're making $50,000 a year, you're not going to have the capacity to borrow $1 million, right? So basically, things to keep in mind when it comes to credit and qualifying for your mortgage, they all are kind of intertwined. But a lender is really just looking at what is your income, what are your obligations, and how much can you afford to pay every month? And then what is your history in terms of have you been paying your bills on time? Have you been paying Macy's and your student loans and whatever it is, whatever monthly payments that you have, they want to see have you been paying all those things on time? And of course, that's going to be reflected in your credit score. Next slide. Now, credit history. This is a big thing, a big stickler for a lot of people, and it's sometimes more intimidating than it needs to be. Most people in my years, a couple decades now of doing loans and helping people with their credit, usually credit is not that big of a deal for most people because what I find is that for the people who have lower income, they may have or who have a lower scores, they usually don't have a lot of credit to pay off because it's kind of like a vicious cycle. If you get a lot of credit, you usually at some point have had the ability to qualify for that credit, and you will at some point be able to get back to having a positive history. If you've never quite made it to where you've been able to get a lot of credit, so your scores are kind of low, it's not that difficult to improve lower scores. Make a long story short, if you have a history of at one point, let's just say at one point you've had very good credit and then something happened, life happened, and your scores dropped. It's a little bit more difficult to get back up to where you were if you've had a lot of credit and then defaulted. On the other hand, it's not impossible. On the other hand, if you've had a low score and you've always had a low score and never have been able to make it out of having low scores, it actually is possible to work your way up a little bit faster than someone who has been up there and then fallen. I hope that makes sense. In general, your credit score and your credit history, really your credit scores are just a snapshot in time. Those things can change constantly. Your credit score can change like multiple times in a day, just depending on what's being reported and who's reporting it. So I guess I'm just trying to say that whatever is showing on your credit, if it's not up to where you need it to be, usually you can do things to improve your score. One of the main things is to just, if you have a low score, is to start paying things on time. That's one of the biggest drivers of your credit is, are you paying your bills on time? If you're paying them on time and you're not getting over your limits, you're not getting in over your head, your scores are probably going to be pretty good. On the other hand, if you're not paying on time, it's pretty easy to see your scores tank. Like current liabilities, if you are a person who is very conservative with credit, your scores are probably going to be high. And it's kind of another thing where the money goes to the people who don't really need it. If you have a lot of good credit, everybody will give you whatever you need. If your scores are not very good, you don't have a very good history, nobody's going to take a chance on you until they see you doing something to make improvements. If you have no credit history, that's better than having a bad history, because you can actually build up a good credit history pretty quickly if you're doing the right things consistently. Generally, uh, lenders are looking at the most recent 2 years. So even if things were horrible in the past, after 2 years have passed and you started consistently paying things on time and creating a positive track record, you can probably see your scores increase much quicker than you might have thought. Next slide. Okay, what makes up your credit score? So the biggest thing is your payment history. I think that's 35% of your score. The amount of debt, or your debt to income level or debt to credit level, is 30% of your score. Basically, what we're looking for is to make sure that you're not maxing out all of your credit cards, because that's a red flag to lenders, to say that you're basically living off of credit, living above your means, and that's not what you're looking to do when you're trying to get into a home. So ideally, if you can keep your debt, your amount owed, below 30% of what you actually have available to you, you're going to see the highest return on your scores. Your length of history is 15% of your entire score. The types of credit or credit mix is 10%. The last two are the least important, but they still count. The types of credit. So basically, a lender's looking to see, do you have a history of having revolving debt and also installment debt? Revolving debt would be like your Macy's credit card, your Sears credit card, your gas card, that kind of thing, where you have a limit and you can go no higher than that limit, and they want to make sure that you're paying that consistently and handling it responsibly. And then an installment debt would be things like a car payment or student loans, where you borrowed X amount of dollars and you have a certain amount to pay it off. So they want to see a good mix of installment debt and revolving debt. And then new credit is 10% of your score. They're looking to see that everything on your credit report is not new. Basically, they want to see some history and not you just racking up a whole bunch of new credit, without a history that they can rely on to see if you're actually going to pay your loan back or not. Next slide. Okay, tips for improving your credit score. Now, this one is huge because, believe it or not, most people have some inaccurate information on the credit report, and it may not seem like it's important if it's a little thing like an address that's not yours, or a misspelling of your name, it may not seem important, but it really is. So, because let's say there's an address on your credit report that is not yours, but the person that actually belongs to that address has credit cards like crazy, and they're not paying that information on time, even though that's not your information, whatever's attached to that address will come onto your credit report and affect your scores. So number one thing that you always want to do, and probably even before you start trying to get approved for a loan, is to see what's on your credit report. Now, you can do that on your own by going online. You can go, I think you can go to myfico.com, and you can actually buy your credit reports with the scores, the same scores that a lender will use to see what's there on your credit report, and see what your scores are, and make sure that the information is accurate. You have to keep in mind that as a consumer, the law says that anybody reporting anything on your credit report, because they didn't come and get your permission, most companies that are doing this have some profit motive behind reporting your information. And so they have a responsibility to make sure that anything that's being reported about you is 100% accurate. So you should be checking and making sure that everything on there is correct. And I have had many clients over the years who come in and they have issues with credit and they need help. And my first thing, you don't want to go in and dispute everything, because you will find that, and some shady people will tell you to just go in and dispute everything. What I tell clients to do is ask whoever's reporting anything about you that has any inaccuracy, is to have them prove it or remove it. And basically what that means is, if whoever is reporting something about you, and this has nothing really to do with the credit reporting agencies, we're just talking now about whoever's reporting something that's not accurate, you have the right to go directly to them and to ask them to prove whatever they're reporting about you. You don't have to go and say, look, this is not mine and this is why, and prove anything, because they're reporting it about you. So that's the first thing. Go in, see what's there, and ask anybody who's reporting anything about you to prove it or remove it. Usually that's the quickest way to get things resolved. Obviously, paying your bills on time is going to help your credit scores. But if you have a history, and especially if it's a long history of not paying things on time, you have to realize that you can start paying things on time today, but it's gonna take a while to build up that track record that's to the point where it's going to affect your scores, enough to be able to qualify for a mortgage. Minimize outstanding debt. Obviously, you don't want to have maxed out credit cards, and if you do, you want to have a plan for how you're going to pay those things down, because a car loan, I've seen it many times, that someone who is planning on buying a home and knows that they want to buy a home, for whatever reason has decided to go out and buy a car with a payment of $700 a month, right off the top, that's going to reduce your buying power by like $100,000 or more. So you have to be very careful when you decide that you are going to buy a home, looking at your debts and making sure that you're not accruing any new debt that's not absolutely essential is going to be key in making sure that you can get a good, affordable loan. And that goes back to only opening accounts if you need them. If you don't need it, don't open it unless you're trying to build credit, and we can talk about that as well. Next slide. So correcting
Lisa,
your, yes.
before you continue, I'm
Go
so
ahead.
sorry. There was a question, and
Yes.
you mentioned when their credit is being reported,
Mhm.
there are several agencies that it
Right.
gets reported to, and
Right.
so do they all matter, or are there specific agencies that lenders look at when they're looking to apply for, let's say, a
Yeah.
mortgage loan?
Okay, that's a great question. So
Okay.
the big three credit reporting agencies are TransUnion, Experian, and Equifax. So those three all count. But keep in mind that they don't all have the same information, and that's why you will typically have three credit scores. And it just means that you might have, I keep saying Macy's because my first job was at Macy's. But you might have a creditor who is reporting to all three, right? And they're going to report the same information to all three of the credit bureaus. You may have another creditor who's only reporting to one or maybe only two. And so that affects what your scores are with each different agency. So the way a lender is going to look at your credit scores is, ideally you'll have three, or typically you'll have three credit scores, and they're going to take the middle of the three. They're going to throw out the high, throw out the low, and use the middle. People, for some reason, I guess it makes sense that people think they're using an average, of your credit scores, but really what it is it's that we just look at the three of your FICO scores from the 3 credit bureaus, and we're going to use the middle one to see what you qualify to use that as your score for your file. Now, when it comes to what you're going to do with these different credit bureaus, when you're looking at your credit report, or when your lender's looking at a credit report, everything is listed there, and that's why it's called a tri-merge, because it means that all 3 of the bureaus are reporting on one report, and they're all merged together. So everything is shown there, and you can go down with your lender, looking at the credit report to see who is reporting what. So if there's something that's negative on the credit report that's not accurate, it may only be reported by one creditor, one credit reporting agency. And so that is who you will go to if you have a problem with the agency that's reporting it. If you have a problem with the creditor that's reporting it, then you can go directly to the creditor before you go to the credit bureau, if that makes sense.
Okay.
And that's, go ahead. I'm sorry.
No, it's okay. No,
Did I answer the question?
Good. Yeah, I think they just wanted to know what was the difference between all, and if they all get the same reporting in terms of how they use credit, and when the mortgage lenders look at it, is there one that is more dominant than the others? But I think you'd answer that. So.
Yeah. Okay. Here's once you've gone through the process of if you have an issue with what's on your credit, and you're trying to resolve it, and you've tried everything, and in the end, nothing works, you do have the option to write a statement that you can have the credit bureaus attached to your credit report. But in all honesty, it's really going to come down to your underwriter. Because that's the person who's looking at your credit and who's going to make a decision, and looking not just your credit, but your whole picture, and deciding whether or not they're going to give you the loan. If you have a good loan officer, before you ever go to an underwriter, they're going to work with you on what's on your credit report, and if anything needs to be addressed, they'll help you with that up front. If you have, I've seen a few credit reports where there is a statement that explains what happened, but generally speaking, your underwriter is going to tell you after they look at your file specifically, or they're going to tell your loan officer specifically, here's what we want to have explained, and they will look to you to give an explanation, which is earlier when I said one of the C's of credit is circumstance. So a thing that I want you to keep in mind as you go through the process is that if you have something that has happened in your past that would be considered extenuating circumstances beyond your control, that is something that might be that you can overcome, as long as you let an underwriter know what's going on, you explain it, you prove it, and if you can explain, like maybe there was a death, that it needs to be extenuating, something really terrible that happened that affected your scores in a negative way, you can usually give an explanation to overcome, what might have been a denial of your mortgage loan. Okay, next slide. Okay, problems. Of course, late payments is one of those things that if you have 1 or 2 late payments, if your scores are really high, like you're in the high 700s, you make 1 late payment, your scores might drop 100 points. If you have lower scores and you have a history of making late payments, then the late payments, your scores are probably already kind of on the lower side, so the late payments aren't going to impact you as much as someone who has been flying really high and then suddenly something happened. That is a negative. That's going to be a big drop. Bankruptcies is probably the worst thing that you can see on a credit report, but it can be something that you can overcome. Keep in mind, like I said, most lenders are looking for what's happened in the last 2 years. So believe it or not, if you've had a bankruptcy and it's a chapter 7, which is a bankruptcy that you have totally written everything off. You have gotten into a situation where everything is just unmanageable. You don't have enough income to make your payments on time, and you've decided that it's just best to start fresh, to use the bankruptcy laws to get yourself a fresh start. If that's the case, if you have filed a Chapter 7, written everything off, paid no one basically, believe it or not, after 2 years, you can actually qualify for an FHA loan. And you know, it's something that people do every day. If you file a Chapter 13, which is it's called a wage earner plan, where you are filing bankruptcy, but instead of just saying I'm not paying anybody, you go to the courts and you make a plan where, based on whatever your income is and your living expenses, you'll work with the court and determine what you can afford to pay for a certain period of time. And then you will pay that. And once you pay it over time, then the bankruptcy is discharged. But if you file the Chapter 13, you can actually get into a mortgage after 1 year of making those payments on time, if the court agrees. So even though a bankruptcy or even a foreclosure, all these things that people think of as, oh, my life is over, I'm never going to get back and be able to buy a home, or, it is possible to get back up there if you do it the right way and leave bad habits in the past and start, paying things, bite off only as much as you can chew, and then use your credit very, very sparingly. That's what a lender wants to see. After you've had a tragedy, they want to see you get back up and start making your payments, but they want to see just a new history, to show that, things have changed. Judgmental liens, of course, those are negative things as well that can show up on your credit report. But I think that the laws have now changed, at least in California, where judgments really aren't showing up. Judgments are, where you go to court, you get sued, and you have to pay someone some money. I'm not seeing judgments on credit reports anymore, and I think that's because the law has changed. And if you do have a judgment on your credit report that is accurate, you know, let Suhei connect with me, and I can try to help you with that, because I don't think that judgments are showing on credit reports anymore. Collection accounts definitely do show. So if you have a debt that was due and you haven't paid it, and you've gone past like 120 days, then it's going to show on your credit report as a collection account, and that's a pretty bad thing. But you can rehabilitate yourself by contacting your creditor and making arrangements to start paying. It might even be possible to negotiate, if you can pay off or settle the debt, basically, where you say, okay, I will pay X amount of dollars, for this collection. We'll agree. And then maybe, sometimes they may even agree to delete it from your credit report. A charge off is what happens after you've had a collection account and they've been calling you for a year or something, and you haven't paid, and then they just decide, okay, we're going to write this off, and they're not even coming after you anymore, but it shows up on your credit report as a charge off. They basically, your creditor has said, okay, this is a bad debt and we're never going to collect from this person. But believe it or not, charge offs, when it comes to FHA, a Federal Housing Administration, which is the easiest loan to qualify for. Charge-offs, you don't have to pay them off. They kind of will affect your scores, but if they're on your credit, the federal government really doesn't care. It just depends on your lender and what they have to say about it. Of course, foreclosures and repossessions, we've seen a lot of those, like in 2007 when the mortgage industry crashed, and there were lots of people who lost homes. That affects your credit for longer than actually maybe even a bankruptcy, in terms of how severe it looks to a lender, because it's a mortgage. A foreclosure says you had a mortgage and for whatever reason you didn't pay your lender and they had to take the home back, basically. That is a little more difficult to overcome, but again, depending on the type of loan that you have, you can come back from it. Next slide. So negative information generally stays on your credit report for 7 years. That is true. Bankruptcies, depending on the type of bankruptcy, will stay for 10 years. So if you have a Chapter 7 bankruptcy where you just wrote everything off and said, I can't pay, I'm not paying anybody, and the court took a look at your paperwork and agreed you can't pay, then that's going to stay on your credit report for 10 years. If it's a Chapter 13, where you actually were making payments and you kept up with the agreement that was made with the court, then that actually only stays for 7 years. Judgments, like I said, I don't think those are showing up anymore in credit reports. I'm not seeing them anymore. Your lender is going to ask you when you apply for a mortgage if you have any judgments, and it's up to you to say yes or no, because I'm not seeing those on credit reports anymore. And then student loans, in general, we say the student loans stay on your credit report for 7 years, but it really just depends. That really means student loans that have been paid off can stay on your credit report for 7 years and then drop off, but what I see is that student loans will follow you forever. They will stay on your credit report, and if it's a good history, then that's a positive thing. It's going to stay on there, and it just shows that you paid your student loans off, which, for some people, that's in the hundreds of thousands of dollars, and that's a good thing. But for some people who have had student loans for decades that they haven't been able to pay off, and they've been in forbearance or deferred, those will stay on your credit report as long as they are owed and haven't been paid off, but they can also be a positive. Okay, and then inquiries where someone is pulling your credit to see how you're doing with your credit, those will stay on for 2 years. Next slide.
Question before you move on to the
Yes.
next slide on student loans.
Yes.
So if someone pays them off and they will stay on their credit,
Yes.
but it will be a good positive thing on their credit report.
It's a positive thing, and that's definitely something that you don't want to remove, because in a lot of cases, your student loan might be your oldest debt. Your student loan might be the first thing that the first money that you've ever borrowed when you were in college, and so that establishes your history. So if you have a positive history with student loans, you want that to stay on there, because that might be, if you remove it, that makes you look like you haven't had credit for very long, whereas you might have had it for a decade.
Okay, and then based on what was going on with this pandemic right now, a lot of people were deferring student loans because they weren't making payments. Right. Now, does that affect their credit score dramatically while they're deferring payments?
Not at all. Not at all. It's a problem. With COVID, it's not, since your payments weren't even due, it's not a negative at all. It's just,
but it's just accruing. It's just accruing interest. So in the long run, you end up paying, I imagine,
with
more.
COVID, not with COVID. If it's if your loan is deferred and it's not COVID related, yes, it is accruing interest. But with COVID, they have stopped counting interest, and there's no payments due until further notice. I think it was extended for another year, but don't quote me on that.
Okay. So, but in just as a rule of thumb, though, you do want to be consistent and you do want to be responsible with student loans, because they will follow you for life.
Oh yeah, forever. Yeah, they don't go away. And you can't get rid of student loans. Well, let me say this. you can get rid of student loans if you file bankruptcy, but it's a process that you have to go through. So even if you did file bankruptcy, your student loans, 9 times out of 10 will still follow you and you still have to pay those unless you open a different lawsuit within your bankruptcy to prove that it's an undue hardship and you will never be able to pay them off. You can come out of bankruptcy, generally speaking. Most people don't even try to get rid of a bankruptcy student loan in bankruptcy. So even if you come out of bankruptcy, your student loans will still be there. They don't have to be, but they probably will be.
They will still probably be there.
Yeah.
Just another question on this last slide that we were on. Do collections stay on for 7 years also?
Yes, yes.
Okay.
Unless you negotiate with the with your creditor. Very often, once they've gotten to the point where they're trying to collect, keep in mind, there's a process with credit where your debt may have been sold. When it becomes a collection, you probably are dealing with a collection agency. And that collection agency has probably paid pennies on the dollar for your debt, right? And then they'll come after you like you borrowed $1 million, and they will call you incessantly, right? But you can negotiate with them because ultimately their goal is to get the money from you. So keep in mind that they may have paid. I'm not saying don't pay your debts. I'm saying pay your debts on time. As that's the best thing that you can do, is take out as little as you need, only what you need, and pay it off as quickly as you can, and definitely pay it on time. But if you get into a position where you do have collections showing on a credit report, chances are a lot of times it's going to be with a collection agency that you don't know anything about. I mean, that you don't have a relationship with them. They're just trying to make money. So you can go directly to them and negotiate to pay them in exchange for deleting the information from your credit report. And there's nothing wrong or illegal about doing that. There's no law that says that this collection has to follow you or has to be reported. If it's possible to negotiate with a collection agency, and I think you should do it.
So where you're basically, what I'm gathering is, if someone, let's say, was in a very tough situation, let's say, and they weren't able to make this payment, but now they're in collections, and they're able to pay something, they have some leeway to negotiate with the collection company, so that at least they may not be able to pay their full debt, but at least negotiate an amount that's doable.
Exactly. Exactly. Yeah. And you can get it in writing with a collection agency. A lot of them are willing to say they'll remove it once you pay.
Which I guess we went into the next slide, because it's kind of what you were explaining right now: writing an explanation letter, negotiating a workout plan, negotiate discount fee offs. Okay, great. I'll let you go back then. Thank you for answering those questions.
Okay. The only thing I want to say on this slide is talking about seeking professional help. Be very careful about people who call themselves collection agencies, which there are good not collection agencies, credit repair agencies. There are some good ones out there, and then there are some scammers out there. So you have to be very careful. There's nothing that a credit repair agency can do that for a fee, that you can't do for yourself if you know what you're doing. So it's against the law for anybody to collect money from you up front to repair your credit. So if anybody is trying to do that, that should be a red flag to you, that they generally do not get paid until they should not be getting paid until they do something that actually helps you. But keep in mind, if you have a good loan officer, someone who understands this whole credit thing and how things work, they can probably work with you to look at your credit report, see what's there, see what needs to happen to get you ready for a mortgage approval, and without you having to pay anything except for the cost of your credit report. Okay, next slide. Debt management plans. Now, this is something that you have to be very careful with. because a debt management plan, you see commercials and advertisements all the time for companies that will promise you that they will reduce the amount that you owe all of your creditors and reduce, you can make one monthly payment to them. And some of them are reputable and some are not. So you have to be very careful because debt management plans can sometimes show up on your credit report and it affects you just like a bankruptcy would. So if you're thinking about it, you have to ask a lot of questions of whoever it is you're thinking about working with. Definitely start the process of credit counseling using a HUD-approved counseling agency. NeighborWorks is one, Consumer Credit Counseling Service is another one. You can look on the CFPB, Consumer Financial Protection Bureau's website, and you can find HUD-approved agencies near you that will help you for free, deal with handling your debt. There's a mention here of re-aging accounts. This is something, I just want to make sure you know what that is. Re-aging is where, let's say you have a collection showing up on your credit report, but it's actually something that was from years and years and years ago, so long ago that you don't even remember the details of it. What happens is that your debt can be sold to a collection agency, and then they can change the date on your debt to make it look like it's a new debt. And remember what I said about most lenders are looking at what's going on in the last 2 years. The older something gets, the less impact it has on your score. So if a collection agency re-ages it and makes it look like new again, then that's going to have a more devastating effect on your credit scores. So be on the lookout for dates on your credit report to make sure that if there is anything negative, that the dates are correct so that you are not having something look newer than it actually is. I see that we've got very few minutes left. Am I right? Next slide. Okay, we talked about this. You shouldn't be paying before anything is done, paying someone to fix your credit before they actually do anything. Over-promising, telling you they can, change your world in 5 minutes for $1,000 or whatever. Be careful with those things. Work with a reputable lender, and usually you and your lender together, if they're experienced and they understand how these things work, will be able to resolve things without you having to pay anything. Okay. Non-traditional credit, this is a big thing. And this is for people who, to no fault of their own, just don't have credit. Maybe you come from a culture or a history, a family that doesn't believe in, debt. And maybe you just don't believe in borrowing money, running up debt. That's actually a very good thing. So chances are you do have a history of paying your rent on time. You do have, a history where you are paying utilities, childcare. You might have made a loan from a family member, a friend or family member, things that you pay consistently. Just know that if you don't have credit, you can use, if you don't have traditional credit, which is, credit cards, student loans, car loans, that kind of thing, your lender can actually help you build a non-traditional credit history that can be used to help you qualify for a mortgage. So even if you don't have a score right now, that's something that you can build using the history that you already have from paying rent and utilities and all those kinds of things. Even a cell phone bill. Next slide. We talked about paying bills on time, ways of establishing credit. There are lots of different ways. This might be, for some people, be considered a cheat, but to me it's not, because I've seen a lot of people come to me who are younger people whose parents had the foresight to add them to a credit card, add them to all kinds of different credit as an authorized user. And once you do that, that person's positive history will follow you and actually help you build credit fast. Now, don't do it with a family member or a friend who has bad credit. You don't want to do that. But if you have a family member who's willing to either co-sign for you, put you onto one of their accounts that has positive history, then that is a jump start. You know, I had a young man who was in his early 20s who had his parents give him his give him have him as an authorized user on their immaculate credit, and he bought a home with 700 plus scores with not a whole lot of personal credit, but using their credit. It's only advisable if you're a responsible person. If you're not, it's not going to end well because you'll end up ruining that person's credit and your own. So only you have to be careful, but it is a way to establish credit. I think we kind of talked about most of these things here. I think I want to sum this up because we're running out of time, but basically you need to connect yourself with either a credit counseling agency, HUD approved, and or a lender who understands this process and who is going to help you walk you through. Because a lot of this is going to be intimidating. You are probably not going to understand everything. One thing that I recommend if you have a lot of debt and you're trying to figure out how to pay it down is to Google PowerPay. PowerPay is a program. It's offered by the Utah State University Extension Service. If you Google it, you'll be able to find it. They have a couple of videos up there, and it tells you, you put in all of your information into their system about all the debt that you have, what the limits are on your credit cards, what the balances are, and what your interest rates are. And they will help you come up with a plan to pay it off quicker, faster, and more responsible. So you're using the money that you have to pay off. Essentially, the way it works is to pay off like the smaller debts quickly. That's going to improve your credit scores. And then the most expensive debt, you know, well, let's say you have $500 a month to pay on debts. You're going to use their system to pay the small stuff off quickly, and then look at the higher interest rate or the more predatory debt, pay that off, use the money that you would have been using to pay off those small debts to make bigger payments towards the higher interest, and then just chip away at it to get rid of your debt faster. Okay. Identity theft. There's a lot available online about identity theft. I think the most important thing is to just be very jealous of your social security number and your all of your personal information. Don't give any of your information to anyone that you don't know and that you don't trust. And then keep your stuff safe from people who could do you harm. I've actually seen a lot of things happen with people who just weren't careful with their information, and suddenly they find out that they have a mortgage on their credit that didn't belong to them. And sometimes it can be a parent, believe it or not. So just be very careful with your personal information. Don't share it with anyone unless they really need that information. And then if something happens, immediately file a police report and keep a copy of that police report, because that is going to be helpful to you when it's time to clean everything up. You do have rights. There are lots of laws and things have changed over time. So, you know, what I would say is connect yourself with a good loan officer, with a good credit counseling agency that's HUD approved, and then they can work together to protect you and help you get ready to be mortgage ready. Next slide. This is just, I would advise coming back to the San Pablo EDC's website just to look over the various information that's available there. There's a lot of law that's out there to protect you. The Consumer Financial Protection Agency is a newer agency that you can use to kind of jumpstart any kind of disputes that you may have, because most consumers don't realize that there is law in place to protect them, to take care of things that may have been done to you against the law. It's very common. So just know what your rights are. And there's a list of several different laws that are in place to protect you. The Fair Credit Reporting Act is a big one. Fair Debt Collection Practices Act, the CFPB, Consumer Financial Protection Bureau. You can Google them, and they have resources there to help you if you feel that your rights have been violated in any way. That's next slide. I think this is basically just going over everything we just spoke of. And we are at 6:01. Are we going to answer any more questions if there are any?
Yeah, just to let everyone know, thank you so much, Lisa. So everyone, these slides will be available if you want to get some information from them that you think will be helpful. I've also have put Lisa's contact information on the chat box. I have her full name, her email, and her phone number. But you can also reach out to San Pablo EDC if you just want to have us connect you with her if you have more specific questions that you would like to ask. And if you are gearing up and getting ready to be home ready and you're looking to apply for a mortgage. This is, again, it is a series of a few webinars. We were having one a month, but in the month of October, we'll be having 2 webinars. On October 12th, from 5 to 6 again, we will be doing obtaining a mortgage loan. So that's the next webinar after this one. And then on October 26th, we will be having shopping for a home and protecting your investment. And then our last one will be on November 16th. And that we will be talking about special financing. So Lisa is getting very detailed in terms of getting you home ready. But again, if you wanted to work with her and you have questions like that are more specific to your situation and you don't feel comfortable asking here, again, I have her phone number and her email on the chat box, or you can contact me. My information is here. You can either email me, call me, or you can also visit our website. If there's anything specifically that you want to revisit on this webinar, like I said earlier, we are recording it. So once it's ready, we will have a link that will take you to the recording. But I guess, let me see if there's any questions that were sent. So when we're looking at applying for a mortgage loan, what would be considered a good credit score, and does the credit score is it the major part that affects what the interest rate that you're going to get?
Okay, yeah. That's a great question. Ideally, you want in this market to have a credit score that it's at least a 660, the middle. And remember, we're going to use the middle of your 3 credit scores. If you only have 2, we're going to use the lower, and if you only have 1, then we'll use that. But you want to ideally have at least a 660, because that gets you in the door for a lot of programs that'll help you with your down payment and closing costs. But really, with FHA, you can have a score as low as a 500 or 580 and still qualify for a mortgage, but your interest rates are going to be higher. So yes, unless you're using programs that are affordable programs that are designed for first-time home buyers, a lender is going to look at your credit scores, and the lower the scores are, the higher of a risk that they're going to perceive you as, and then the higher your interest rate is going to be. That makes your loan more unaffordable. So ideally, you want to, before you get in there, maximize your scores. Do whatever it is that can be done to get your scores up as high as possible. And then work from there. So you can, like I said, be approved with a 580, but generally speaking, I wouldn't want to go and try to get a loan if I don't have at least a 620. And if you're trying to get assistance, down payment assistance programs are generally looking at between 620 and 660. That would be the goal. If you know, but the higher the better though. But don't let your score stop you. You know, you can get it up.
Okay. The last question is, how often is my credit score updated?
It can be updated multiple times in one day. And here's the way that it works. It's your information is just being reported to the credit bureaus. It does not have a score attached to it until someone pays for a score. So like if a lender, a broker like me or a lender is pulling your credit, that is when your score is generated. So your score is just a snapshot in time based on when your credit report is being pulled. So if they pull it today and my bankruptcy hasn't shown up yet, it's going to be much higher than if they pull it tomorrow and then my bankruptcy is there. So it's just a snapshot in time, and it will change depending on what's being reported and who's reporting it at what time. So it's a definite thing that can change constantly. It may not change at all if nothing is changing with your financials, with your, your accounts.
And I imagine as a lender, your lender, whoever's working, will basically guide you as to certain things that you should keep away from doing while you're applying for a mortgage loan, just to make sure that you're staying in the clear and you're not making anything fluctuate within that time frame that you're looking to close on a home.
Right. You can change things if they're going to improve your profile. You can pay off debt. You may be able to refinance a car to get a lower interest rate, or, things like that. If it's going to improve your situation, then great. But you really shouldn't change anything. Once you are working with a lender and they've told you, okay, you're pre-approved and this is the amount that you're pre-approved for, you don't want to do anything without checking with your lender first, because I have seen people buy a car for the house that they don't own yet, to put in that driveway, and it just scuttles your loan. So you don't want to do that. Wait until you close on your home before you do anything major,
Okay. Well, thank you so much, Lisa, for sharing such great information as always and resources. Thank you to everyone who joined us today. We hope that we see you on the next webinars. Again, we have 2 in October, so please visit our website. And whoever is subscribed to our newsletters, you should be seeing those weekly. We keep promoting those. So please, there is some really good information. And again, if you want to follow up with Lisa, you can either contact her directly, or you can contact us and we'll put you in and connect you with her and give you her contact information if you weren't able to jot it down. But yes, please feel free to reach out to her or to us directly. And again, please join us and register for any of the upcoming San Pablo EDC webinars that we will have. And I hope that everyone has a wonderful evening. Thank you again, Lisa. We really appreciate your time.
My pleasure. Thank you for that.
All right.
Bye-bye.
Thank you, everyone. Good night.